It is January 9th, 2024. The clock ticks past 4:15 p.m. Eastern Time. On trading floors across the globe, a single devastating announcement flashes across screens, confirming the U.S. Securities and Exchange Commission has approved a suite of Bitcoin exchange-traded funds. Billions of dollars in capital move instantly, the price of the digital asset surging based on the perceived official word from the regulator that oversees Wall Street. Then, silence. Just moments later, the SEC denies the post, confirming the message was fabricated, a lie injected directly into the heart of the global financial consciousness. How could the agency tasked with protecting markets from fraud be so comprehensively breached by a single 10-second message? The resulting market shockwave is estimated to have involved trades worth $15 billion before the digital smoke cleared, all hinged on a single, crucial vulnerability: a phone number. Chapter 1. The Digital Landmine. The digital infrastructure of the SEC, a bastion of federal finance, was designed with layers of defense, yet the entire edifice was apparently keyed to a single, easily compromised piece of authentication. The immediate aftermath was chaos, a violent testament to regulatory power. When the SEC released its official statement confirming the post was not their creation, the damage was already done, leaving a deep, visible crack in the foundation of institutional trust. Legal analysts immediately noted the incident wasn't simple mischief. It was an attempt to corrupt the market through disinformation, prompting swift engagement from the Federal Bureau of Investigation. The pursuit led from the fractured digital chaos of the crypto exchanges straight to the front doors of federal investigation. Live. Chapter 2. The third-party flaw. The technical investigation began where the breach occurred. The social media platform confirmed the SEC account was hijacked, not through an internal system break, but because an unidentified individual obtained control over a phone number associated with the account. This discovery directs the investigation outside the SEC's direct purview, focusing instead on the digital handshake used to verify identity. It suggests the vulnerability wasn't a complex zero-day exploit, but rather a catastrophic failure in a trusted partner's system, a third-party vendor. Visualize the architecture of digital identity. Every major platform relies on SMS verification or two-factor authentication tied to a mobile identity. The attack method strongly implies a successful SIM swap, a procedure where an attacker tricks a mobile carrier into porting the victim's phone number to a new SIM card under the attacker's control. The key to cracking the SEC's access was not hacking the SEC's internal servers. It was corrupting the phone company responsible for managing that single line of communication. This single, poorly protected phone number became the golden key, allowing an outsider to bypass all the SEC's multi-layered security protocols and speak directly as the regulator. Chapter 3. The Echoes of a Larger Wave. This event did not happen in a vacuum. The SEC breach was one of several high-profile social media takeovers targeting official accounts, shortly before and after the incident. Cybersecurity firms and government bodies suddenly found their authoritative voices weaponized to push outright financial scams. The incident suggested a pattern, a chilling wave of coordinated digital assaults aimed at exploiting the trust placed in official sources. If the SEC could be taken over via a phone number, what other government or corporate systems were relying on that same weak link? The SEC's mandate includes direct oversight of the burgeoning crypto markets, meaning their word carries immense weight for pricing and adoption decisions. For years, the SEC delegated its most important announcements regarding landmark decisions to this third-party social platform. That decision, to use a channel dependent on vulnerable mobile authentication, is what allowed the fiction of ETF approval to send billions of dollars into motion before the truth could catch up. Experts predicted the fallout from this breach would linger for months, a slow erosion of faith in federal communications that standard security fixes alone could not instantly mend. Chapter 4. The Face of the Failure. The sheer impact of the misinformation placed the incident firmly in the historical context of major corporate fraud and market deception. The government needed an answer, and the narrative began to shift from systemic failure toward criminal intent. Late in 2024, the pursuit concluded with a concrete arrest by federal agents. The individual taken into custody was linked to the digital chaos and the subsequent allegations of Bitcoin manipulation. When the FBI gets involved, the operation is clearly categorized as high-level financial crime, not mere digital trespassing. The core mystery remains: how exactly did the attacker identify, target, and successfully execute the porting of that specific phone number associated with the SEC Gov account, especially when the SEC was using a platform that claimed its own core systems were secure? The answer lies in the shadow economy of identity theft, the willingness of a third-party entity, be it a carrier employee or an exploited vendor access point, to trade one digital asset for another. The physical realization of this digital crime is abstract. Figures manipulating unseen databases from anonymous locations, their digital shadows causing tangible, multi-billion-dollar movements on a screen. The entire regulatory framework, built on layers of verification and authority, proved to be balanced precariously on the reliability of a single, port-ready phone number. The $15 billion hack wasn't just an attack on a social media account. It was a demonstration of how brittle modern digital governance has become when identity itself can be stolen via a voice call to a stranger.